Hey everyone, welcome to the KE Report, another daily editorial, this time chatting with Craig Hemke. Craig is the founder and editor of TF Metals Report. We'll post a link to Craig's website in the show notes. And as always, we'll focus on the precious metals. However, it won't just be on the precious metals because boy, oh boy, we're all seeing what the markets did last week and how the precious metals were also caught up in that big drop. Gold right now is actually under $3,000 on the futures exchange after being a few $100s higher than that. Silver's under $30 right now. However, it is up today. But again, Craig, this is a period of time that it feels like we have lived through before where markets start to crash, and still seems early stage potentially for this market crash or pullback, and everything gets sucked down with the markets, including precious metals. What was your takeaway from last week's action, especially at the end of last week?
Yeah, we've certainly watched this movie before. Yeah, you just kind of put yourself in the shoes of a hedge fund manager, that's kind of got a portfolio that's spread all across all these different asset classes. And when everything's going down and you've got to raise some cash or you want to move to the sidelines, you may very well take a profit in your gold position. And you might do so, one, because it's liquid and ready to roll, but you've got maybe some losses in other things that you are dumping to raise cash or, to get some liquidity. And you can use those to offset your gains. What was gold up in the first quarter? 20%? Just the first quarter. So, there's a lot of reasons as to why it seems like everything surges in one direction. And that's definitely been what's taken place since late Wednesday. It's very frustrating to watch. It's a little bit disheartening every time it happens. What's funny is just last week in our discussion last Monday, we talked about how, wow, this looks a lot like we did back at the end of October. Everything was just rolling and gold was up at 2,750 or 2,800 or, whatever it was. And everything looked great. And then kablamo, after Trump got elected, what did we drop? Almost exactly 10%, bottomed out middle of December and then rallied again. And maybe that's what happened. I mean, here we are a week later, kablamo, and the bottom has dropped out. We're not down 10% yet. That would probably take us down to about 2,800 or so. If that's the case, who knows? Maybe that's where we're headed again this time. But it has been, again, as usual, very frustrating to watch. One last thing for people to note, though. After being closed on Friday, and so not having a chance to react to everything else going on around the world from Thursday until last night, the Chinese markets, the equity markets sold off sharply, down 9-10%, depending on how you looked at it. But right after the Chinese open, gold and silver shot higher. Silver rallied 10% in about 45 minutes, from the lows of 2,750 to up to about 3,050. That's noteworthy. Let's see if that trend continues. I mean, it's writ large, the trend for 30 years now, up in the Asian session and down in the New York session. I mean, they got charts that show that. But that might be a trend to watch as we go through this week to see if we continue to see physical buying moving price up in Asia and then paper dumping for all these other purposes, the reason we discussed, taking place during American hours.
Yeah, Craig, it sure boggles the mind how volatile things have gotten just in a week or two with these price moves, exaggerated moves, compared to what we were seeing, which was a steady climb higher. And to your point, yeah, we had a steady climb higher last fall, only to get wiped out after the election results, then a steady climb higher in Q1, only to get wiped out by these tariffs being implemented. But the other thing that's interesting is, as we've talked about with you before, Generalist, we're finally starting to pay attention to the sector. Q1 has to be the best quarter this sector has ever had as far as margin expansion and profitability, record revenues. That was going to start attracting more generalists into this tiny sector. And it was going to start having people that screen for earnings and screen for price outperformance, get it on their radar. Now we've just had the rug pulled out from underneath us again. What do you make of the current environment? Will people even care about a record Q1 in the gold sector?
Yeah, it'll be kind of hey, that's great. You had a nice quarter. And now look where the gold price is now. You won't be able to do it next quarter. So we're just going to sell. That is how it often happens. if you're in a downtrend when all that news comes out. Now, look, things could change over the course. So we got a long ways to go. But by the time we get to the end of this month and you start getting, production results and stuff like that, and by the time we get into May and you get earnings again. So we'll see how that plays out. But it is frustrating in that regard. After the shares had actually bounced and all traded pretty well on Thursday, well, then we all know what happened on Friday. And of course, Friday morning, I mean, terrible timing. I can't remember who it was, UBS or Goldman Sachs or somebody raised their price target for Newmont to $95. And you think, God, any other time, right? If we were just going sideways with gold at 31.50 and suddenly a big bank comes out with a price target of 100% higher on the flag bearer, you'd have thought, oh my God, what a great day. And instead it just gets lost in all of this other stuff. It's exasperating. But, for those of us like you guys and me that have been in this sector longer than we want to admit, it also seems like it's just par for the course.
Craig, how do you view the stocks at these levels? Because they did well. They outperformed the market. A lot of arguments that they should still be way higher than they currently are. But again, we don't seem to have investors just rushing in over each other to buy these stocks. The volume still is relatively low on something like GDX. But again, these stocks, or at least GDX, almost doubled in about a year from that March period when it started to take off. And it did really well in the first quarter, but now that we're in the second quarter, a couple trading days in and the market's falling, they're also falling. But they haven't quite fallen to the same extent as, let's say, the big S&P index. So how do you view these miners?
Well, I would just ask everybody to continue to take a long-term point of view. And if you can get the long-term trend right, then you're going to be okay. I mean, yeah, it's another pullback. It's another consolidation phase. A technical analyst might call it a bull flag phase on all these charts. If we are, in fact, in a long-term bull market, if the fundamentals for gold and for silver too remain unchanged, and we're talking about the debt-based monetary system just being this monster that has to be fed with greater and greater currency debasement, through fiat issuance. It's a long sentence. And if that means higher gold prices, well, then you would sure think that the bull market continues in the metals and the bull market continues in the shares. But it's never straight up. And whenever it does begin to go straight up, like last October or toward the end of March, that you get the elevator back down. And that's kind of what we've seen. But it's just a consolidation. It's 2 steps forward, 1 step back. The speculators rush in and they buy futures contracts on the COMEX because they want gold price exposure. And then you get to the point where they're all in and everybody's going to buy as bought. And then just by deduction, you're left with more possible sellers than possible buyers, and down goes price. And then everybody rushes the exits at once because they want to lock in their gains and blah, blah, blah. And eventually you get back to some kind of an equilibrium from which you can start to rebuild. I mean, we don't have to look back very far. This is exactly what we went through in a 6-week period from late October into the middle of December. You get a little double bottom, you move up, you start getting back above key moving averages, and you accelerate again in your next leg higher. It's agonizing to watch. It's frustrating. I wish we had nothing but green candles every single day, but that's not the nature of the beast, and it's probably not changing anytime soon.
No, Craig, and I don't think anybody expects to see green candles every day, but I'm a little less sanguine than both you guys when I look at these markets, because I look at us as we've been in a bull market for years now. I mean, let's not forget that in 2022, gold was at 1618 and that the triple bottoming, and it's been over $3,000. I would look at GDX, it just barely a week ago or 2 weeks ago got above its 2020 peak, yet gold is tacked on $1,000, and these producers have the fattest margins they've ever had in history. Not just this Q1 quarter we're talking about, but also in Q4, it was the best record margins they've ever had. GDXJ didn't even get above the 2020 peak. So we can celebrate that these gold stocks did well in Q1 and that they did well last year in the fall. But these things are valued at levels that are even crazier than they were a couple of years ago because of where the price of gold is and where their margins are. Is there something else fundamentally broken in these markets? Because I'm not celebrating a 20 or 30% move in these stocks up this year, some of the stocks doubling since last year, when they should be at record high prices and they're nowhere even close, let alone where they were in 2011. Is something broken in this gold space, Craig?
Partner, I'm afraid it gets back to what the three of us have discussed for years. And it's a broken sentiment. It's an ignored sector. There are so many other options now compared to even 10 years ago for the speculative dollar. So much so that many of these gold shares almost seem like they're value plays, like a utility stock that pays a 6% dividend, defensive value plays. Well, again, last 2 days notwithstanding about being defensive and value plays. But it's just in a world that's focused on growth, our whole sector you can't even say it's an afterthought, because that would imply that somebody was giving it consideration and then going, nah. I don't even think in a lot of cases we get consideration. Now, again, that could change. A continued decline in growth, and gold price surges back over the next 90 days, this could all change rather dramatically. What happens if, Warren Buffett, who now famously moved so much cash to the sidelines in the last, 45 days, well, suddenly he starts nibbling at Newmont again, that sort of thing. So it will be possible to improve and get on more investment radars, for lack of a better term. But man, I think, Shad, for now, again, the answer is just what we've lamented for years. And it's just that we kind of toil in an investment area that used to be kind of a hot story. It used to be a place where people would go for alpha, as they call it. But now there's so many other options, whether it's internet meme stocks or, whatever, that we're just kind of overlooked. I wish I could give you a better answer than that, but that's just kind of how it seems.
I think you are right, though, Craig. And as much growth as we've maybe seen from these stocks, again, it's been on the metals price front, right? Where we haven't seen just a massive amount of M&A or big deal after big deal. We have seen good amounts of M&A, and it does still seem like it is very much a bull market for these stocks. But yeah, it's a sector that isn't providing the type of production growth that investors might want. And they're not really returning a ton of capital to investors. Do you think that's a different nuance there, where you are right, these are defensive stocks, very much so, but they're also not dividend or income stocks because they're not returning capital to shareholders. So shouldn't the big companies be doing that? If they're not going to go spend their money on other assets to grow, why not give it back to the shareholders?
Well, my friend, that might be a better question for the heads of Barrick and Newmont and Agnico and all the rest, to press them as to what they do, how they do what they do. And, the one thing, though, and again, another topic that we've discussed a couple times this year, it becomes, when we talk about it as a sector, maybe we just, as investors and people that are interested in this sector, we just need to do our, focus more on individual names and try to do our homework and buy the right ones. The ones, if all these big producers are banking another $1 billion onto their books this quarter, well, then maybe there is going to be more M&A. And maybe if we start to do some homework and realize, hey, look, that big mining company with all that cash it gets a lot of their production out of this particular area. And oh, look, there's another company that has staked a bunch of ground and drilled a bunch of ground and has proven it up, and they're right next door. Maybe I should just invest in that one, and rather than buy, a whole basket of those. I don't know. I feel like I'm giving long, rambling answers to your questions and kind of speaking in generalities. But, a time like this with so much uncertainty about where we'll even be by Friday, I think anybody that tries to be more specific about where they think things are going or where they think companies should be doing, I think we should all probably just take a step back and let a few things play out in the interim.
Yeah, it's a good point, Craig. And I do think it's also a good point that you made, that it's a time to be a stock picker and look for the opportunities instead of trying to invest in the sector, invest in the better opportunities. Let's also pivot back over to, in such a wild environment for all markets and in a wild environment with volatility, have you seen any big changes as far as the COT reports, as far as silver or gold? And I would imagine the report that's coming is going to be a whopper.
Yeah, do you guys remember using the term the last couple of weeks? I called it a dichotomous cot. Remember talking about that? And that's what it was. From a historical basis, which really is the only thing that these reports are useful for. From a historical basis, the net positioning of the speculators versus the commercials in gold was relatively favorable. And over the last 2 weeks, gold had gone up rather nicely. Silver, on the other hand, not quite so favorable. In fact, looking a little heavy. And over the last 2 weeks, silver had actually barely done anything. In fact, it had fallen. Had really having trouble getting through that 34 area. Remember that? So what we're seeing now, of course, in this rush to raise cash, liquidations, book some profits, whatever, is a big contraction in open interest, particularly in gold. And that will be then reflected in this week's commitment of trade report, which will be surveyed tomorrow, the 8th, at the COMEX close, and then released Friday, the 11th at 3:30 Eastern. Already last week, as of last Tuesday, before all this sell-off began, the total, we'll just call them the large speculator, hedge fund, everybody else, total large speculator net long position, take their gross position and subtract their short position, their net position. It's about 238,000 contracts, which sounds like a lot. That's actually the lowest it had been since the survey of November 19th. Well, we just got done talking about how crappy November was. So we're in the midst of just getting hammered. Price is actually going to go a little bit lower in the 4 weeks that followed. But already, as of last Tuesday, the net positioning in gold for the speculators was the same. We've now seen, hell, even on Friday, guys, we just got the data. Friday price for gold was down $86, but open interest was down 18,000 contracts. That's large spec liquidation. That's the sign of it. So large specs are liquidating longs. The commercials are using that selling to buy back and cover their shorts. The open interest gets retired. Falling 18,000 contracts down to 467,000. That's the lowest, just about the lowest open interest of all year 2025. And if I'm right, by the time we get this week's commitment of traders report, we're going to be looking at some of the smallest in that gold category, the smallest that we've seen since May of last year, maybe even May of the year before. So it doesn't mean that gold can't go lower. It doesn't mean that more liquidations can't follow and make those large speculator net numbers even smaller. But it is the same thing that we've always talked about. 2 steps forward, 1 step back. The speculators rush in, the speculators rush out. And that's how these bull markets unfold. And they're in the process of rushing out. And the next time we move up, they'll rush right back in, but hopefully from a higher low. And then that next move will take us to a higher high versus this last one, again, which is very definition of a bull market.
Very true. As well as overbought conditions and better sentiment, which we have seen a lot towards the precious metals, which, look, these environments, at least from when we've seen them in the recent past, the couple big downtrends that I've lived through and I've been focused on the markets is that, yes, everything gets pulled down with these markets, but precious metals do bounce back very quickly, usually the fastest and very strong. So it is just, I think so much focus needs to be paid to the markets and just when the downtrend, when the negativity will slow, and we very well will see then precious metals really rebound strong. Craig, great chatting with you. As always, Craig is, again, the founder and editor of TF Metals Report. Click that link in the show notes to follow along with Craig. Craig, have a great rest of your week. Thanks for your time today.
Okay, boys, you too.